Hello everyone. Today our group will be a presentation on topic of U.S. monetary policy spillovers to emerging market exchange rate. As we all know, U.S. monetary policy plays a very central role in a global financial system. This is mainly because the U.S. dollar is a dominant international currency, widely used global trade, investment, and foreign exchange reserve. Because of this, when the United States changes monetary policy, especially through the interest rate hike or cuts, the impact is not limited to U.S. economy. Instead, this effect quickly spills over to the rest of the world, particularly to emerging market economies or EMs. For example, when the U.S. raises interest rate, global investors tend to move their capital back to the U.S. in search higher and safer return. As a result, emerging markets may experience capital outflows, currency depreciation, and increased exchange rate volatility. These exchange rate movements are not just financial statistics. They can affect inflation, external debt, financial stability, and overall economic growth in emerging economies. Therefore, in this presentation, we will examine how U.S. monetary policy influences exchange rate dynamics in the emerging market, and why understanding this spillover effort is crucial for maintaining economic stability.
This section talks about the theory and the studies on how U.S. monetary policy affects emerging market currencies. There are three main channels. First is uncover the interest rate parity. When U.S. interest rate goes up, U.S. assets become more attractive. Investors move money into U.S. This causes capital to leave emerging markets and their currencies become weaker. Future U.S. interest rates also matter, not only the current rate. Second is the global financial cycle. When the U.S. tightens monetary policy, global liquidity becomes lower and the investor becomes more careful. As a result, money flows out of risk assets, include emerging market currencies. Many emerging markets depreciate at the same time. Third is sovereign risk channels. Here, U.S. interest rates increase the cost of U.S. dollar debt in emerging markets. This raises country risk and puts more pressure on exchange rates, especially in countries with higher external debt. Recent studies after the pandemic show that the impact is difficult across countries. Emerging markets with strong and credible monetary policy. Early interest rates increase, and the good economic fundamentals had more stable currencies. This shows the U.S. policy corrective the stroke, but domestic policy debates how strong the effect is.
Next, I will briefly present to you the core data on how U.S. monetary policy affects emerging market currencies. First, the change in U.S. interest rate. In middle 2025, the Federal Reserve kept the federal funds rate in the range of 4.25% to 4.5% to cover inflation. In December of same year, it cut the rate by 25 basis points to 3.5% to 3.75%, marking a policy pivot in response to slowing global growth. As the global benchmark interest rate, its adjustment directly affects global capital flows. Second, the trend of the US dollar index for emerging markets. The index rose from 127.31 in 2023 to 131.86 in 2024, and further climbs to 134.11 in 2025, reflecting the sustained strength of the US dollar against emerging market currencies. Finally, there was a divergence in the performance of emerging market currencies. In 2025, the Thai baht and Malaysia ringgit remained resilient, while the Indian rupee and Indonesian rupiah weakened, affected by external balance conditions, capital flows sensitivity, domestic policy, and foreign exchange reserves. It is not difficult to conclude that U.S. monetary policy and the strength of the U.S. dollar are the core drivers of the exchange rate movements of the emerging market currencies.
Now look at the discussion. The transmission mechanism works mainly through capital flows and exchange in global risk settlement. Here, U.S. interest rates increase the opportunity cost of holding emerging market assets, encouraging international investors to shift capital back to the U.S., which in turn places depreciation pressure on emerging market currencies. At the same time, a stronger U.S. dollar affects exchange rates beyond the interest rate differentials by shaping global financial confidence and investors' risk perceptions, thereby amplifying capital outflows. Differences in foreign exchange reserves, external balances, and domestic policy responses help explain why the impact of U.S. monetary tightening varies across emerging markets. Economics with stronger reserves position and more stable external fundamentals are generally better able to observe external shocks, while timely and credible domestic policy responses are further enhance resilience against these spillover effects.
To conclude, this presentation shows that U.S. monetary policy has strong spillover effects on emerging market exchange rate. Because the U.S. dollar plays a dominant role in the global financial system, changes in U.S. interest rates do not only affect the U.S. economy, but also influence many other countries. When U.S. interest rate rise, global investors are more likely to move their money back to the United States. And as a result, many emerging market currencies depreciate, and the capital flows become more unstable. And our findings also show that although this trend is common, the size of impact is different across countries. So this means that domestic conditions don't matter. Emerging markets with stronger foreign exchange reserves, healthier external balance, and more credible monetary policies are usually better able to handle these external shocks. In contrast, countries with weaker economic fundamentals are more vulnerable to sudden capital outflows and exchange rate pressures. Based on these findings, several policies implications can be drawn. First, emerging market governments should continue to build up foreign exchange reserves to protect against the external shocks. Second, maintaining stable and credible monetary policy can help increase investor confidence. And third, macroprudential policies such as capital flow management tools can reduce excessive financial volatility. So overall, understanding U.S. monetary policies spillovers is very important for emerging markets. It helps policymakers design better strategies to reduce risk and improve financial stability in an increasingly globalized economic. So that's all. Thank you for your listening.